Perfect. Okay, so does someone want to give the opening prayer?
Yeah, I'll do that.
Awesome. Thanks, Dave.
Our dear Heavenly Father, we're grateful for this day and for all the opportunities that we have here, and we're grateful for this opportunity that we have to meet and discuss this case and ask thee to be with us so they'll be able to understand what we're supposed to do and they'll be able to communicate clearly. And again, we're grateful for our blessings, and we say these things, Father, in the name of Jesus Christ. Amen.
Amen.
So we're doing a prayer like on a computer.
It was weird when I was watching one of the YouTube videos to just make sure like it was doing well, recording was working, everything, and they have the prayer, and I'm like, okay, so I'm not sure if I can just skip over this and it'd be okay.
Crazy.
Okay, so I guess we can jump right in. The first question is, I guess so, oh no, that's at the end. Okay, so what value would you place on RightNow Technologies?
Okay, real quick, what's the case again? What's right now?
It's the one where he started it up himself. It's like how he helps customer service in different other companies. And so he came up with some kind of programming that goes across the internet that helps out. And so he's trying to decide, someone gave him an offer to buy it outright, an acquisition offer, or they can plan for an IPO, or they can just keep growing themselves and wait.
Well, this is the
If that gives you enough information.
is this the John Forte guy?
Yep.
Yeah.
Okay, so I remember he was like rich because he sold something else first.
Yeah. He had already done a technology company, and he had already sold it, and he retired for a while, but then he just wasn't happy with it. Like, he wasn't happy with his life. He felt like he was unfulfilled. And so he started looking to figure out if he could come up with a company that would solve another problem.
I'm just trying to, Bozeman, Montana, that's right. All my classes are all case study classes, so I'm like, yeah.
Yeah, and I'm trying to remember. So I'm trying to go back and find I gotta go find what I submitted, because there was a method to what I valued them at. Because in the case it talked about the different multiples that the company was willing to offer them, and so I'm trying to.
Well, it seemed like they were doing multiples, but on like 50 or 60 million instead of the 35 million that the revenue. Oh, there's Marshall. There's the sick man.
So here's what I said. So because I went through, like, in the back, they have all the different, like, addendums or whatever, and it talked about all the different sales that had happened in that same space. So I took the average of the sale prices, and the average sale price multiple was 2.75 times. So I took the 50 million, so their forecasted earnings times 2.75, and came up with 137.5. And then I also did it times the highest sales price multiple, which was 4.34, and came up with 217. But then it said that the venture capital benchmark was 2 to 3 times last round's post-money valuation. So it was saying,
which was like 126, right?
Yeah. So the last money post-round valuation was 129. So I think the minimum that a venture capitalist would accept would be 2 times, which would be like around 258. 3 times that would be 387. So I just said, based on the terms provided by the potential buyer, the fair market value, in my opinion, would be in the $250 to $350 million range. Based on all that.
I kind of did guesswork on this because I was like, I don't know how to do this. But I started out the same way that you were talking, Kenny, with that paper that it talked about all of the sales that had happened. And I just kind of averaged it, and I came up with about 100 million valuation. So that's how I had come up with my number.
Yeah, so that's kind of how I did it, and then I remembered that said that the venture capitalists would take 2 to 3 times last money for the last
Yeah.
round
I had
multiple.
forgotten about that part.
Yeah. Yeah, I did some little cheesy Excel little wannabe, I don't know, I didn't even do a graph, just like a table of showing all the different, if they sold it for this, how many, what's the multiple based on what price? Because I did multiples based on the 35 million and then multiples based on the 50 or 60, and then the 2 or 3 times the 129 or whatever it was. Dang, I am like having the hardest time. I'm like trying to scan this case study, and I mean, I know it's like instead of sending out the discs to people for the software, it was just like almost cloud-based software or something like there, or something before cloud was there. But I'm trying to remember what the actual, because even when you explained it to me, can't believe I already forgot it that quickly.
Well, the product's weird, so it's kind of like Salesforce, so it's like CRM management and stuff like that. So they basically host your website traffic, and I don't know, it sounds like I don't get the technology, but
I thought the general thing was like just taking care of ways to get customer feedback and work with that.
I guess technically, according to what they're asking us, it doesn't matter.
Yeah.
It does, because anyway, okay. So, oops, that's not it.
So at the very beginning, it says he had come up with an idea for a software product that would help companies respond to their customers' emails.
oh yeah, that's right.
And that's how it all started.
Weird.
So, I don't know.
Okay, let's see. Group assignment instructions. Okay, I'm gonna get back on there. All right. Marshall's like bored out of his mind because he can't say anything.
Just so y'all know, Zach said that he's still at work, so he might miss the meeting.
Okay. All right. So.
Okay, so that basically goes over all of the valuations that we could come up with, correct?
Yep.
Okay.
Yeah, so like 1 and 2, that kind of describes 1 and 2.
Yeah.
Okay, so 3, I don't know if you guys know the answer to this. If the investors seek 30 to 50% internal rate of return, what exit value will they expect? So is that saying, if they're saying, are they saying they're expecting a like 30% on, like if they've invested $1 million, they're expecting a $300,000 return, so therefore the value on the thing, I don't know. I don't know how to arrive at the exit value.
Oh, sorry, go ahead.
No, I just don't know how to arrive at the exit value.
I remember we had talked about rate of return either last week or the week before, but I couldn't remember. And we had talked about both rate of return and exit value and how it would change it and everything. And I think we did an Excel document with it for one of the cases, but I could not remember it for the life of me.
Yeah, I mean, you have any idea, Ken?
Well, yeah. So I mean, so the internal rate of return basically takes the net present value of all the cash flows and derives at the value But I don't know where this company, like, they're cash flow positive, but I don't know how to calculate it.
There's
Okay.
an internal rate of return calculator online.
So
I don't know if that might help.
discount rate.
So there's this.
Whoa. What happened? Oh, you shared a screen.
Sorry, I just shared my screen real quick. I don't know if we can use this or not.
Is there any way you can move it over to the right?
What do you mean?
I don't know, for some reason. Or wait a minute. Oh, never mind. Is that how I had my screen divvied up?
Oh, gotcha.
So yeah, I can't remember what the initial investment was.
Oh, it was wasn't it 16 million? Both of them were like 16 million, weren't they?
So yeah.
Yeah, in terms of the seed rounds.
Yeah.
What do we just do 16 then?
Yeah. Let me see if I can go find it real fast.
I mean, it was 16 and some change.
Yeah, exactly. It was something like that.
So what I didn't understand, and maybe I was just missing some piece of the information, but I know in the case study it was saying that they were cash flow positive, but then when I was looking at their like financial sheets, they were in the negative and everything. So like I don't know if I'm just looking at the wrong thing.
I wasn't it just last year they were cash flow positive?
I think so, yeah.
Yeah, I know what you're talking about, Catherine, because I had that same question because it was talking about how they were cash flow positive, but then if you look at their financials,
Yeah.
even before like all their expenses like tax, depreciation, and amortization, they still were negative, I think.
Yeah, and so that's what I just didn't understand. If I was missing something.
Let's see.
Because there's also nowhere where it was negative and then it changed to positive.
Wait, what was that? What did you say? What about being negative and then change to positive?
So, because it was talking about how in the years before they weren't cash flow positive, and then the last year they finally got cash flow positive. And so while looking at all the financial sheets, I was trying to just find a spot where like they were negative the past few years, and then this last year they were positive. But it's either they were always positive, they were always negative, or they went from positive to negative.
So right here, Exhibit 6. So Exhibit 2 is 99 to 2003.
Right.
And net income's negative, but their forecast for '04 had them positive at 2.2 million.
Right, yeah, I saw that part. So was that what they were talking about when they said they went cash flow positive?
That's what I understood, that it was just their last year they were finally cash flow positive and like apparently on that trajectory. So they really didn't need an infusion of cash anymore per se. That's kind of what I got from that. Because yeah, now that I look at these exhibits, I remember thinking the same thing. I'm like, cash flow positive, what are you talking about? It's all negative.
Gotcha.
Yeah.
But and it was weird how much it fluctuated. You would think it would just be like a gradual. Of course, I didn't really look at everything what costs were incurred, but
well, in 2003, I mean, their revenues just kept growing.
Yeah.
On a pretty healthy trajectory. So I think 2003 their net loss was negative 9 million or
4 million. All right. What?
Well, because I'm looking at Exhibit 8, because like
Oh,
they're in 2004 currently, right? As of when this
I
was
thought
done.
they, as of the end of the case, they were 2003. Because they were saying they were
that's
planning
Salesforce
for
that you're
an
looking at.
IPO in 2000.
Oh, whoops. Yeah, that's Salesforce's data. Whoops.
Yeah. Yeah. Their data is Exhibit 2.
Whoops. There we go. All right, there we go. Sorry about that. Yeah,
So they actually had like a $6 million swing, from being 4 million negative to 2 million positive.
Yeah, that's true.
Yeah, John Forte. Well, what did you guys say? Well, maybe I'm asking a question that doesn't need to be answered. What did you guys think he should do, just out of curiosity?
Um, I kind of had two different answers. Because in our own personal analysis assignment, it was like what option makes most sense for the one guy, and then what option makes most sense for like the stakeholders.
Yeah.
I personally thought that the best thing for the company overall would be to accept the acquisition and grow within a larger organization, because even though things were looking up for him, they still weren't quite positive in profits or anything like that. And so the best way to 100% ensure the future of RightNow was to take that acquisition. The only thing that I had against that was that the one guy wanted his company to be a certain kind of company, and he would possibly lose say in it by taking the acquisition. Does that make sense?
Mm-hmm.
Okay.
Yeah, I was a little similar to that. I thought if it was, as investor, if it was the VC making the decision, they would want to go the IPO route. If it was the board, they would want to do the what you said, do the acquisition and try to grow larger and be more visible with a bigger company. But I thought if it was John Forte making what's his friggin' name?
Yeah,
It's
something like
stupid
that.
saying the last name.
His first name's
Anyway,
Greg.
it's what?
Is Greg?
Oh, Greg, that's right. If I was Greg, I would, because his whole goal was, to grow this company in Montana, get 2,000 employees, all that kind of stuff. And he, the first time around, sold out pretty early for 10 million. And so I could see him, thinking, hey, I'd like to, just hold on to the company, grow organically, and maybe become a bigger company that could be acquired later on rather than right now. Because they were saying they were still kind of small for the IPO. They got rejected for the IPO. Really wasn't working out the first go around. But they were kind of small potatoes looking for an IPO. So anyway, okay. So what about you, Ken? Nee?
Oh,
Kenny?
I think he's frozen.
Oh, he's just got his arm up.
Sorry, I am currently finding so that we can try to figure out rate of return and exit value. I'm finding how much each round was and then the post-money valuation. Not sure if any of that's going to help, but... Oh, Kenny's gone. Marshall, if you want to say anything, you can always text us in the group. We can pull that up if you want. Or, if you just agree with everything, that's fine too. Whatever works. It looks like, though, when we have to do the write-up, it looks like it'll be pretty easy to split everything up. But, so I guess while I think maybe Kenny will come back on, we can just kind of now, we've kind of been doing it, but, how do I say the word? Do an analysis of each option, because that was the next question after rate of return, is just kind of talk about each option, what would happen with the company.
Yeah, I guess that's what we were talking about.
Yeah,
Yeah.
we're kind of just doing that. But like
that was the. Go ahead. Sorry.
Go ahead.
Well, that's what I was just saying. I looked at it. There's 3 avenues depending on who you're trying to please. You know, it's hard to please anyone. I think the VC would probably still be fine with the acquisition.
Yeah.
He's
back. What
the strategy was, though. What did you say?
He's just popping in and out.
Oh, Kenny is?
Yeah.
Yeah, because didn't he say in this one we don't necessarily have to write case study format? We just do paragraphs with analysis?
Yeah, I think so. Because especially because we have to do the rate of return and exit value, that's going to be more calculations instead of actual writing. And so you're saying we don't have to hit the normal 2,000 word mark for the paper. Anyways, Kenny, did you want to answer on what you thought?
Sorry, computer froze. Anyway, so Dave kind of mentioned at the, last, I kind of think, his whole goal in starting this thing was to create jobs in Bozeman, like 2,000 jobs. And he, had that goal, and he didn't really need the money, and he wanted to do something for the community. And he also wanted to, grow the company, and it was still kind of in its infancy. And where they had the failed IPO, I feel like, they should continue to grow the company, because I felt like he should view that, the takeover attempt or the merger offer as kind of a compliment as to how well they were doing. Because a big enough company came in and was getting bugged enough by them stealing their business that they were willing to pay them out. And so they were still really young. And so I thought, but from the perspective of the venture capitalists and the investors, if you have a really fair offer and, and it's, that's hard to pass up, and exit and make some money. And so, but I thought, from his perspective, I think it makes sense to continue growing the company. Although there's a lot of people that stand to make a lot of money from the deal, and he could help a lot of people currently in his company. His goal was to help the community and grow, a lot bigger than they currently were. So that was my thought.
One thing that was hard for me to make the decision, because it seemed like he wanted to spend more time with his family and everything, and selling would be able to allow him to do that. But because he had already gotten bored once after retiring early, I didn't know if that would happen again. And so I was like, well, maybe he should sell, because then he can be with his family, but then he might not be ready to retire again. Yeah. And so that's why I kept bouncing back and forth. I personally didn't think the IPO is a smart idea anytime soon, because it was so bad the first time they tried to do it, and it just never got off the ground. But at the same time, when that other company, what was it, that was doing their Salesforce, was going public, they could also just miss their chance of going public. So I was kind of torn in all the ways, but
yeah.
Real quick, I just looked up something at exit value, and They're just saying the value can be based either on a recent merger and acquisition transaction in the sector or valuation of similar public companies. Most early stage investors look for 10 to 20 times the return on their investment. Later stage tend to look for 3 to 5 times the return within 2 to 5 years. It says, for example, assume an exit valuation of 100 million and the VC owns 20% of the company at the time of the exit. The VC would earn 20 million on their investment at exit. If the VC invested $1 million into the company, they would make 20 times the investment. So you can either do it on ownership, if you know what their ownership is, whatever that exit valuation is.
Well, so I think we would need to take the amount that they invested, and then because it gives us the percentage that they want, and then we have to find the exit value.
Well, so the exit value would be that valuation, right? The 100, the post money valuation.
Yes.
Oh no! I guess it's 3 times that, huh?
So yes and no, because in the question it's saying if they're seeking 30 to 50%, what would the exit value be that they would expect? And so we can't take an exit value and then go backwards because they already give us the percent of return.
Oh, okay. And then they had put in was it the same company putting in 16 million both times?
So I found it, and the first round was 16.4 million with post valuation of 100 million, and then the second round was 16 million with post valuation of 129 million. Let me see.
But was it both? Was it the same company putting in? Was it the same VC putting in those 16 millions?
That's why I'm trying to find it.
Yeah, I thought they were led by separate. Like one of the rounds was led by Greylock, and then the other one was led by whoever the other one was.
Okay. Well, because I'm just trying to determine whether to base the exit money on, 16 million or 32 million.
I would assume 32. So the second round, Series B round, was led by Summit Partners. Oh no. Oh yeah, and the first one was led by Greylock, but Summit Partners participated.
Gotcha.
Okay, see, I thought there was some connection there.
So I don't really know.
I
would assume we would go off of, well, I don't know because, yeah, I guess I would assume we'd go off of 32.
Okay, so then, it'd be they would want 9.6 million.
Before based on options. I think that.
But it'd be 30 to 50. Oh, hold on a minute. Because that wouldn't be enough either. If it was just based on the 32 million, it's on the low end. The 30% is only 9.6 million, and it would probably be. See, don't we base it on the 2 to 3 times the post money valuation to make the exit valuation?
I thought, because you had just read about the exit valuation, I thought you could figure it out with just the investment and the percentage that they wanted. Or did I just understand that wrong?
No, it says in there that an exit valuation is usually what did it say? 10 to 20 times, or they're looking for 10 to 20 times on their investment. So, like, if their investment was $32 million, yeah, they would be looking at, gee, many Christmas, $320 million. That's why. Did we know what percentage of ownership the VCs ended up with?
Well, it was saying that homeboy, the guy that started the company, still retains 60% ownership. So
Oh, that's right.
I'm assuming 40% ownership, right?
Yeah, that's
true.
probably right. Unless some was divvied up to board members. I can't remember.
It didn't say it was, and
Okay.
and where he bootstrapped it, I think he was able to retain, the majority ownership because he didn't need upfront cash, and so
Uh-huh.
I mean, that's where his 60% comes in, and then Greylock and the other one, Summit, probably split that 40%. But I'm trying to figure out, okay, how do you use the internal rate of return and work backwards to get your exit value? Because you can go off of, the multiples, but I'm trying to determine how the internal rate of return is used in that, because that has to deal with the cash flow. So.
And we don't know the cash flow.
Right.
That's why I'm confused.
So I'm trying to look up.
It's like everything that I pull up, it asks for the cash flow. And so.
Right.
Yeah, and so if the cash flow is negative, then it makes it very hard to.
Well, and the fact that they don't even give us the cash flow, like it says that the cash flow had become positive, but they don't tell us
Exactly what it was.
Yeah, $5, $2 million. That's why I don't know. That might just be a question we have to skip.
So it says, so here's something I'm reading. Okay, in terms of how to calculate internal rate of return, think of it as follows. The internal rate of return on an investment is the annualized effective compounded return rate, or rate of return that would be required to make the net present value of the investment cash flows, whether they be cash in or cash out, equal to a perfect zero. So the rate of return necessary for the investment to break even.
Oh, yeah, I'm going to be the first to say I don't know how to figure that out.
Yeah, what the heck? All right, so.
There's so if it's talking about for the business. Shoot, where did that go? Oh, you've been typing stuff. Marshall's been typing stuff.
It's talking about the IRR for the business. Isn't it just the net profit from the business? So that's what I was thinking, but in the case study, it had said that they had just become cash flow positive again. And so that made me assume that they had to have been negative before. But I can't, when I was looking at the financial statements, I just didn't understand it. Wasn't it statement 2? So that's why I'm trying to Google how to find cash flow to see if there is just a formula that we could use with the numbers we have.
Yeah.
Okay, so real quick, backing up. So Marshall, you kind of think that he should just sell and move on to another project? Is that what I kind of interpreted? Okay.
Man, Marshall, this must suck. Okay, so I found a definition here online, and it said determine the company's earnings before interest, amortization, and depreciation. Add together net income from operations, interest, amortization and depreciation, known as EBITDA, and this number represents the cash flow available.
So if it's talking profit.
Looking at the statement of cash flows, it means they are spending more money than what is coming. Interest and taxes can change to
A positive to a negative. Yeah, see, and that's how I was taking it too. They're negative because they're having to spend more than they're taking in right now to keep ramping up. So their internal rate of return would be bad right now. So I don't know why you would base the we're all scrounging or scouring over the
This is dumb.
case.
That's all I'm going to say.
What did you say, Catherine?
It's dumb.
Oh.
Yeah.
You're there still, right, Kenny?
Yeah, I'm here.
My screen shrunk up, and so not everybody's on the thing.
So I'm wondering, okay, so it's saying that I'm looking at their balance sheet and their total stockholders deficit in 2003 is $45,254,000. I'm wondering if that has anything to do with, because it shows how the series A and B break out, but then I don't know.
Where?
Okay. Well, so my computer's going to die soon, and I don't have my charger with me. Can we talk about the rest and then, I don't know, figure this out sometime? Or y'all can keep going.
No, I mean, we can, because that's part of our group assignment, right?
Yeah. And just a side thought, the last time when we didn't answer 2 questions, it was only like 3 points down. So if we still have an exhibit of some kind, I don't think it'll hurt us too bad. But I would still like to try to figure it out. But I think it's just going to take a lot more time than we actually.
Well, number 3, we could just try to. Well, but we could do for number 3 just, if the investors are looking for 30 to 50%. Yeah, man. That's a sucky question.
30 to 50% internal rate of return.
What exit value will they expect?
I feel like that's kind of a tricky question.
Can you work back? No.
I would think it would be more if they seek a 30 to 50% rate of return on their investment, then what exit value will they expect?
Yeah, exactly. I think you're onto something, Dave. I think that's kind of what I don't know. It doesn't make sense to like go and try and analyze their cash flows.
Like take the word internal out, and just 30 to 50% rate of return. What exit value? Maybe let's just answer it that way instead of trying to come up with something that doesn't exist, maybe.
Right. So then you would just take, the series A and B, and then you apply a 30 to 50% multiple on it, right?
But then how would you come up with the exit value?
Well, the exit values is the 2 to 3 times the post money value. So their second round is 129 million. So 2 to 3 times that should be the exit value, and see if that gives them at least it would give them more than That would give them way more than the 30 to 50%, because on 32 million.
Well, with an exit value, don't you have to take into consideration paying what's his face too? Greg.
Yeah. Yeah. So
that would make sense because it's all forecasting for a certain amount of time. Cash flows are to our.
Okay, so what was it? 129 million?
yeah. So if you went maximum 3 times that.
Is 387, and then multiply that by 60%. It would be 232. What did I say the first one was? Shoot.
Well, do you want to take that question, Dave?
The number 3?
Yeah.
Yeah, that's fine. I'll toy around with that and come up with something.
Okay.
To me, 1 and 2
go together.
Kind of go together.
I can do that.
And that would work because 4 is you analyze each of the 3 options and then
do 1 and
decide
2.
what he should do.
Okay.
Sorry, Kenny, did you say you'll do 1 and 2?
Yeah, I'm happy to do that because I feel like I have kind of a decent grasp on that. So
yeah, I feel like you gave the best answer when answering it.
Are you cool with describing one of the or analyzing one of the things, Marshall, on number 4?
Do you have a preference, either the IPO, the acquisition, or growing on their own? He's typing. I would prefer the growing on their own. Okay, sweet. Then I will take the acquisition, and we will hand off the IPO to Zach.
Okay.
And if that all sounds good, I will have to at least leave, and I don't know if that'll end the meeting for everyone, because mine
it will.
at like 2%. So.
Well, we forgot to put a timestamp, right?
Well, if someone wants to just summarize, because I think at the very end, it says, at the end of your meeting, take time to give summary of your votes and final decision and thoughts. And so if someone wants to do that right now, then I'll just know that the timestamp's at the end. And
okay, go ahead, Kenny, shoot it.
All right, so in this discussion, we have gone through and analyzed all of the different scenarios. As a group, we feel like an IPO wouldn't make the most sense for the company, but we do feel like either keeping the company private or merging with the potential parent company is a good idea. Either one of them is a good idea. It just depends on what John Ford, what his long-term goal and strategy is, where he is the majority shareholder of the company. And it also depends on the venture capitalists and kind of what their plans are. And so we feel like it could go either way. And they're in a great position, and they're creating a lot of jobs in Bozeman, Montana.
Okay, and then I guess just really quick, because we have to have we're supposed to say, based on our analysis, what should Greg do in the paper? And so I guess if we just want to vote real quick between at least us, and then we can text Zach maybe.
So Greg's best interest, right?
Well, no, it just says
just what he should do.
just overall, consider Greg's goals as well as the goals of everyone else who is involved. So you have to consider everybody, but overall, what will be the best?
Wait, real quick, Catherine, you were analysis of IPO?
No, I am analysis of
acquisition.
Yeah. I personally, like, thinking after talking and everything, I do think it would be a really good idea to kind of keep growing on their own, because like some really good points were that they are a threat to bigger companies, which means that they probably will keep growing and becoming even a bigger threat and a bigger company themselves. And I think that Greg isn't quite done with the company yet. So That's my vote. That's Marshall's vote.
I vote.
Vote.
Yeah, that's fine with me.
Okay, so we will just end the paper with that is what he should do.
Perfect.
Okay. And so Zach's doing the analysis of the IPO.
Yep.
Okay. I'm doing the text right now.
Okay, awesome. Well,
All right.
my computer is about to go, so
Thanks, guys.
Do you want to create